radio for a really great future. We're talking real money.
Maybe I'll insert a noisemaker effect here because it's the new year. Yeah. Hi, welcome to the beginning of 2026. Holy mackerel.
It's a big year for you. I know that.
It is? Does something happen
is.
this year? Oh, no, please don't say that number. Oh, my gosh, I just realized what
I'm
happened.
saving it. I'll use it appropriately.
7 decades ago.
Yeah. That's a long time, my friend.
Don't say the number. You're going to depress me. Hi, everybody. Welcome to Talking Real Money, not my real age. I'm Don. That's Tom annoying me. But that's okay. It's his job.
That's my job this year, next year, all years.
He does what he's supposed to do. Exactly. He's very compliant. I want to ask you a couple of really important questions because I think they'll put today's show in perspective. All right? Here's a basic question for you. What is a bond? What is a bond?
You're asking me what a bond is?
Yeah, you can answer it. What is a bond?
That's when you have a tight association with another human being.
Okay, wrong bond. It's a secure. We're talking real money.
Oh, money, money.
Relationships.
Yeah, okay.
It is a security.
That would be, a security that has a guarantee of some kind.
Right. It has a stated interest rate.
Yep, that's right.
It is backed by someone, a corporation or a government, and it has, most of the time, a set maturity. You get your money back in a year, 2, 3, 5, 10, 20, 30 years. There's a maturity date.
Yep.
So, okay, that is a fixed income set maturity paper. What is a CD, a certificate of deposit?
That's, something similar, right? It's issued by a bank usually. It does have an interest rate attached to it. It has a maturity date.
Right. So what do these two have in common? They are fixed maturity products that have been around for, in terms of bonds, they've been around for centuries. Okay? Tried, true, pretty effective. There are good bonds, there are bad bonds, but you have because of regulation, you have a relatively good idea whether you're getting into a good bond or a bad bond, right? Fixed maturity.
Correct.
So if we have these fixed maturity products that most people readily understand and we know work pretty efficiently, why do we need these new fixed maturity ETFs?
Yeah, and what you're hearing today is this is a great product for baby boomers that want to be able to say, here's how much money I can earn for a period of time. But isn't that what we just talked about a minute ago? Oh, by the way, not all bonds work out. I still have some railroad bonds from the late 19th century that I'm hoping will pay off sometime soon.
But you bought those in an antique store.
I did. Yeah. I had them framed just to remind me that there's no guarantees in life. Yeah, this is the kind of the fund du jour. The fixed maturity fund is what we're talking about here. They're all over the place. Invesco's
They're being pushed like mad.
I know.
There's a lot of publicity about them. So you put your money into one of these funds.
Yep.
And you can get it back at a set date, exactly what you put in plus interest. What does that sound just like?
It sounds just like what you just said. And I looked one up, Invesco BulletShares 2025, the high yield corporate fund they have there that the SEC yield is 3.69.
Wait a minute, that's not the high yield.
That's the high yield, but remember that's 2025. So
that's the high yield for 2025.
Yeah, so if you push it out a few years, it's going to be higher. But here's the kicker. I mean, again, and I asked our friend Larry Swedroe about this. I'll give you his comments in just a moment. But for the pleasure of that, you can pay Invesco 0.43% a year. Now, you could just go buy a
junk bond.
A 10-year, what's 10-year paying today? I don't know, still 4, right? I mean, something like that.
Right at 4, yeah, right at 4. Yeah. I mean, I think I just extended my 5-year CD ladder and I got 3.89.
I was wondering when that was going to start to come down a little bit, but not extremely, right? That's a little bit of a reduction. And Larry said, well, yeah, you just buy bonds, tips, or munis to maturity you want and then save on the fund fee. You just get the same thing.
The fund fee, it provides you nothing but a subtraction from the yield.
The guarantee, by the way, is only as good as the bonds in it. So you could face default especially in a high yield corporate fund, right? I mean, if something went bad,
all they're doing is they're just guaranteeing the maturity. Exactly. Yeah, okay, it'll mature, but will it pay you?
Yeah, and so these are very, as I said, well-sold products. They're all over the place right now. And here's what I see when I talk to you about them. We all do this, by the way, and because you just mentioned an interesting point, and that is, here's what it pays for this period of time, my 5-year CD ladder, et cetera. Everyone tends to focus on the coupon side, and they ignore the complexity or the cost. I see this over and over and over. All I want is the fill-in-the-blank interest rate. That's it. Don't care about anything anybody says after that. And you should, because you don't need to buy a fixed maturity fund, because you can, as I said, you can buy fixed maturities from agencies that have always paid you back, like the U.S. government. You can take additional risk if you want to buy them from corporations. But again, this is a complex product, and you really should want simple and transparent when it comes to investing, I think.
Yeah, and the thing is buying. There is some downside to buying individual bonds, okay, because they're relatively hard to buy. Unless you're buying treasuries, you're going to need to get diversification, which is where the only selling point for these comes into play, is that you get some diversification, particularly on the corporate side. That's where they make the most sense. They don't make any sense on the treasury side, on the government side. None.
Are you still buying? For a while, you were buying those. Which treasury product was that had?
Oh, I bought a couple of those when the yields were 9.
Yeah, that's the I forget now the name.
The I-bonds.
I-bonds. Are you buying any more of those, or are you done with all that? But you could go to TreasuryDirect.
They're still making me money, and they're adjusting for inflation, and I'm happy. Yep. No, I have actually that, which is just, my real inflation hedge is my stock portfolio.
Yes, which has been the better hedge.
Yeah. I actually bought those just mainly to be able to talk about them on the show. And I went, this is kind of, I can get them at, who cares? I bought $20,000 worth. But the bulk of my fixed income is in BND and a treasury ladder.
Okay, so BND is the Vanguard Total Bond Exchange Traded Fund. Holds
right.
8,000 securities or 9. It holds a lot of securities.
Right, and here's the thing: you get great diversification with BND. Yeah, with the total bond market index.
There's mostly government, but there's some corporate in there, et cetera, et cetera. So there's some other stuff.
And for that, you pay.
Is it 3 basis points?
It's 3 basis points. Yeah.
Okay. It's
versus 30 or 40 basis points.
0.43 for the Invesco BulletShares 2025.
For these
and
other
then
things,
you supplement that with your bond ladder.
CD ladder.
Pardon me.
Yeah, CD ladder. Yeah. Because they're FDIC insured. So,
and then when those cash out, you buy the next
immediately. I just had my 1 year mature last week or 2 weeks ago, 3 weeks ago. Boy, time flies. And I just rolled it out to another 5-year CD.
And you made a little under 4? Is that what you said?
A little under 4. Under 4.
Yeah.
But what I'm saying is the only benefit to these is diversification and a fixed maturity date.
Yeah. They're going to tell you
all.
when.
But you can still lose money like you can in BND. So the benefit is it's so small as to be it's just ridiculous. There's no point in owning these. They are just another dumb Wall Street invented. They keep inventing new products because that's what they're in the business of doing. And you don't need to complicate your life with all this stuff.
And people love the fixed maturity. In other words, the idea that I put this money in, and in 5 years, I get the money back. It'll be right in time for when I need it in retirement. That's the part I think people hear. By the way, BND in 2022 lost 7, 8, 9, 10%, something like that, right? I mean, it did have a down year. That was one of the only ones in the last 20 years. I mean, for the Vanguard Total Bond, I think maybe, no, not 2008. But the thing is, it's been pretty steady. It's very inexpensive, and you get the diversification more than you're going to get from the Invesco BulletShares, which is going to hold, a slice of the fixed income market, but not like you get from Vanguard. Not in any way.
Now, here's the thing: we are using the Invesco because of the extremely high expense ratio.
Yep, that's right. That's fair.
They're an aberration, and that's just Invesco. They tend to charge a lot. the SPDR
Fixed maturity fund.
ETF has an expense ratio of 0.15.
Yeah. And by the way, the only reason I'm using the Invesco product is somebody asked me about it.
Yeah. Well, here's the thing, though. If you look at the performance of these, you will see, just like you see with BND, with the regular bond fund, along the way, you are going to see losses and gains in the net asset value of the fund.
Yeah.
Depending on what interest rates are doing.
In 2022, did you get or 2020? Did you get a chance to look it up? I was kind of curious to know. So, I mean, people also, again, going back to fixed income, important thing always to know. Your fixed income is there for portfolio stability, so that when stocks get crushed, not your entire portfolio goes down, right? Number two, it would be a place to draw from if you're in retirement, because you don't want to be pulling money from stocks when they go down. You want to sell those when they go up and take the cash and pay your bills that way. The bond part there can supply income for a long period of time. But don't get caught up in chasing yield. This is another problem I see in fixed income a lot. Like, well, look at the coupon. Look how much I'm making, and I want to make more. No, you want to keep your money with bonds, and you want to make your money with stocks.
BND actually, total loss in 2022 was 13%.
In 2022, right. Okay, that's the year I'm looking at. Yeah, 13. Okay, so it had a pretty rough year. I mean, this year, and we're at the end of the year here, it's made about 7. So it's had a good return. So, and we're kind of feel like we're back to normal.
Is that all of these numbers are things the numbers we're talking about. The only number that really counts is the yield. The other stuff is noise, because and the noise is less than the noise from stocks. Equities have much more dramatic swings. I mean, 2022 was the worst year in a century.
That's a long time, by the way, even to the two of us. So
yeah.
Well,
it was
not that long for you, still long for me.
In large part because interest rates were doing something they hadn't done in a long time.
Yeah. Dramatically.
Rising.
All right. So, yeah, this is something, again.
You don't need it.
Don't put it on your list.
Yeah, when you hear somebody talking about it, remember, they're trying to fill space, either air space or page space or internet space with an article about this newfangled thing that somebody sent them a press release on, and you can pretty much ignore all of it. News, as Eugene Fama said several years ago.
Yep, love this quote.
Every year we see 2 or 3 or 4 new things from Wall Street, and he said over his entire career of 50 years plus, he has seen 1 or 2 that showed any real value.
Yeah. And he did win a Nobel Prize, I think.
He did kind of win a Nobel Prize for that.
Yeah, smart. All right, let's go to the questions from Seattle. Laura writes us, I work for a small business that uses retirement plan consultants based in Utah for a 401k. For about 20 years, my boss worked for, I don't want to mention the firms. They manage our company 401k and offer financial advisory services. You can see more on their website. Mm-hmm. When I started with the company 6 years ago, I asked a lot of questions about their fees. We were paying 0.035. Now, if that was just for the management of the money, that's not an unreasonable charge.
No, that's dirt cheap.
I would be curious to know what they're charging.
0.35?
0.35. I'd be curious to know
0.35. You said 0.
About administrative fees, et cetera. But she says, they seemed irritated, but I persisted because the numbers didn't add up. Roughly a year later, it turned out they had miscalculated the fee, and we had indeed been overcharged. Once that was discovered, we fixed the issue, later changed the plan to a simpler flat fee model. That experience got me thinking, even though they say they're a fiduciary, I'm not sure what that really means in practice for us. Do they act as a fiduciary toward the plan and employees? Given what happened with the fee calculation, I want to understand whether they generally meet the high standards for fiduciary services under ERISA, or whether the fiduciary claim is more of a marketing label than a real commitment. Any insight? So retirement plan consultants, for full disclosure, we used to work with them, but they were not the investing side. We were doing that side. They were doing the
I was wondering where I'd heard that name.
Yeah. So they were doing the plan administration. And of course, that does not have, you don't need the fiduciary standard there. Although when you're managing any ERISA plan, your standard's pretty high. I mean, because
they
the
are
federal
among the
government.
highest.
Yep. So I would be surprised, and I am surprised to hear that they miscalculated the fee as well. But they may be relatively inexperienced to the money management side of this business. That I do not know.
Retirement plan consultants? Is that correct?
That's correct.
Okay, I see a retirement planning consultants as an RIA, but
They're
not
based in Utah, it says.
Utah. Okay, hold on. Utah.
And they manage 401k retirement employer-sponsored retirement plans.
Yeah, they must have somebody else doing their, because they're not an RIA.
Okay. They weren't when we worked with them either.
Yeah.
I
can't find that they're an RIA. So I
don't know what to tell you there.
Without looking at all this, I wouldn't be able to. I'd have to see all the plan documents, and
we'd have to also see what they're charging you for the administration of all this. That's the important part as well, because
that's what I mean. All the plan documents are going to show commissions, fees, expenses. Those are all required under ERISA. All of that has to be fully disclosed. This is not like Indexed Universal Life, where nothing has to be disclosed. Everything. With ERISA, everything has to be disclosed.
You got to put it out there. So
they're pretty strict.
More work to be done there, sir. Jan writes us from Lakeland, Florida.
Oh, gosh, that's just down Interstate 4 from us.
Turn left. Hi, Dom and Dom. Hi, Tom and Don.
That's us. We're just Dom. Hi, everybody. Welcome to Talking Real Money. We're Dom.
I've been with the same advisor for 3 years. Recently noticed several of the mutual funds in my portfolio, I'll give you one, DODLX, are A-share or B-share funds that normally carry front end or back end loads. When I asked my advisor, he told me there's no front load because the fund were purchased through him and everything is fine. I'm seriously considering ending the relationship, moving my account elsewhere. My big concern is if I fire him and transfer these funds, will I suddenly get hit with the deferred sales charge or somehow have to back pay front end loads that were supposedly waived? I appreciate your thoughts on these load structures. Yeah, so if you're in an A-share, no, because you paid it.
She said it was DODLX.
That's what she's got here. If you can't find that one, I've got some other tickers as well.
DODLX is an institutional share.
Okay, try MIOPX.
MIOPX, Morgan Stanley Institutional.
Yeah, so you probably didn't pay
these are
A-shares on those.
institutional shares, but they're not a. Oh wait, yeah. Oh no, institutional internet. Let me just check the price on this one. I just want to double check to make sure.
Yeah, but going back to A shares or B shares. A shares are being upfront charge, so you've already paid that. So
MIOPX is a front-loaded fund.
Okay, so there you go.
5.25 up front. Although I don't know, and the fees. Holy cow! So she's with Morgan Stanley.
Okay.
And the expense ratio on MIOPX, which is the Morgan Stanley Institutional International Opportunity A shares, is 1.34%.
So you're paying that and the lovely commission on the upfront.
You got it.
Yeah. So, but if there any of these are B shares, tell her what you won there.
Well, if they're B shares, then you have a certain period, and it varies from fund to fund, over which you will pay a declining contingent deferred sales charge, which means at the end. So it starts generally at 5 and then goes to 4, 3, 2, 1, 0. If you're C shares, there is no back end. There is no front end. It's just you pay the higher fee every single year.
They're sucking that out. Yep, all the time. Yeah. She didn't mention C, but that and that helps with the.
She has Bs, but this is one of the funds she has. This was an A, and the guy lied because she already paid the commission. Unless, wait, there is a caveat. There is an unless here. And that is if this is part of a company plan and they had enough to reach break points.
She didn't mention that, but she said it's her advisor, so it doesn't sound like a company plan. But back to the Bs.
She needs to leave Morgan Stanley.
Yeah, I no question. But back to the Bs, is it generally, I always forget, a year or two on the back end load?
5 or 6 or 7.
Okay. For some reason, I had a year stuck in my head. Okay,
no. 5
years,
or 6 or 7.
Yeah, that's
for
a long
B-share
time.
Back end loads. Yeah.
And what's she going to pay if she tries to dump them before that? Generally,
it depends on how soon after. 5 the first year, generally for the second, and then it's like 3, 2, 2, 1, 1 or something.
All right. I would probably say bite the bullet because the fund expenses are killing you anyway.
Exactly, because you're paying 1.34. So if you were in the Avantis Global Fund, you would pay 0.23. So you're saving over 1% per year, which kind of makes up for it.
5 times more expensive. That's crazy. All right, Patrick from Olalla, Washington. Hey, guys, past attendee to a retirement seminar, great fun. Question. Retired, 65, have $1 million, and wondering in today's financial world climate, what is your opinion? Is a reasonable percentage of a balanced portfolio that should be in international markets? This comes up all the time.
The portion that is in equities should be somewhere between 70% U.S. and 50% U.S.
Oh, you're going to actually allow those of us that are more invested in the U.S. to
That's why I'm giving
survive.
you a range.
Thank you.
70 to 50. So 40, great number right in the middle. 40% international. There you go.
60-40, 60% in U.S.
In the equity portion of the portfolio.
That's right. We're talking
this
just
does not
stocks.
impact the bonds.
Yeah.
I don't really believe that international bonds are essential. They might have a meager benefit.
We use
there
a
are
little
some
bit
arguments.
in the privately managed portfolios.
There's a meager minor benefit, but bonds are just not a high return vehicle anyway.
No.
So,
they should be viewed as a diversifier only. But the thing is, back to the international exposure. It'll be interesting in the next month or so. We will learn what the new proportional in terms of market capitalization ratio is between U.S. and international, because we'll know that here soon. So then maybe you could say, oh, now it's fill in the blank. It's 61% U.S. and 59% international invested. Now, I still think you can make a great case for your claim, Don, that half your money should be international, half in U.S. That said,
when you look at global GDPs, there's a good argument right there.
Yep. Or you can make a pretty good case on why you should be overweight U.S. But there's no one perfect one. You'll never know the future as long as you have enough exposure. That's why I like your aspect of 40. You should at least have that.
That's why I'm becoming flexible in my old age.
That's a change, because normally intractable would be the.
When it comes to insurance salespeople, I'm intractable.
The door is shut, bolted, locked, slammed.
Because they keep behaving so badly. If they disclosed, well, then they'd be out of business. Okay, never mind.
They'd be out of business or in
if they told the truth, they'd be out of business.
Yeah. The truth, you can't handle it, as they say. So anyway, great question, and keep them coming. It's been busy right here, right through the holidays. Keep those. I love the questions. So,
and it's so easy to send in your questions.
I think you just go to Talking Real Money, right?
TalkingRealMoney.com.
Yeah.
There's a button in the corner that says Contact Us. You hit that, and it gives you a form. In that form, you can type your question, or even easier, if you have a mic with your computer, or like a mic on your smartphone, you just speak it into the microphone.
And
hello, Don
if you
and Tom.
Want more help, more specific help, click on Meet an Advisor and say, I really want to talk to Tom in the new year. I miss him. I love his jokes. I just need some time with Tom, and I'll get it for you. So that's pretty easy, right?
It's
maybe not the joke part.
Maybe
not the joke part. I apologize.
It's Tommy time again.
I feel so much better. You're lifting my spirits here as the holidays come to an end. So
it's Tommy time.
Ouch.
And now
it's time to go away. Thank you for joining us for Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.